Good morning, students. Welcome back to the session on Ind AS. Today, we plan to start with a new topic that is on financial instruments. Very important topic, and at times it's also considered to be a complex topic. So that's why I would say one of those topics under Ind AS which will have major impact on the financial statements of a company. This standard basically, or this topic, I would say basically covers three standards. And all of these three standards are in relation to financial instruments only. But as we mentioned, that in the context of the financial statements, as per Ind AS for any company, the coverage, or you can say the application of this standard is significant. You can easily say that approximately 50 to 60% of the financial statements as per Ind AS will be nothing but the application of financial instruments, at least. And during the course of our discussions for this particular topic, we will just understand as to why this is so significantly applied in the financial statements, or why we can say that at least 50 to 60% of the financial statements of a company as per Ind AS are nothing but financial instruments. The other important part around this standard is, unlike most of the other standards for which there were guidance available under Indian GAAP, for this standard, currently, there is no guidance available under Indian GAAP, and that's why the time when you would have understood Indian GAAP, that means accounting standards, there was no equivalent standard to deal with the financial instruments. So you can also understand that today you are going to start with a completely new topic, okay, for which there is no reference to old accounting standards. And everything under this accounting standard, in a way, is therefore going to become a gap difference. Correct? Yeah. So what I'll do is I'll just quickly take you through the requirements of this standard, first of all, briefly, and then we can just get on to detailed understanding around it. So as you can just see on your screen, there are three accounting standards: Ind AS 32, Ind AS 109, and Ind AS 107. These three accounting standards comprise of financial instruments. Yeah. So through these three accounting standards, we are going to discuss about financial instruments. And before we get into details around these three standards, let's quickly understand the coverage of these three accounting standards. So one is Ind AS 109. Yeah. Second is Ind AS 32. Third is Ind AS 107. Now, very important point in this standard, which you need to remember all through, and please make this a note. Yeah. So currently the discussion that I am going to do will remain applicable throughout this standard, or you can say throughout this topic. So that's why you can just mark this as very important for the purposes of your understanding. Ind AS 109 deals with the classification, measurement of financial assets, financial liabilities. And the other important aspect around this standard is that this is relevant from the holder's perspective. Now, who is a holder? Let's suppose a company has issued preference shares. Okay. A company has issued preference shares, and the issuing company is A Limited. A Limited issued preference shares. A Limited issued preference shares. And these preference shares were issued to B Limited. So that means B Limited has invested in preference shares of A Limited. So in this case, A Limited, this party will become issuer or will be called as issuer. So they have issued the preference shares, and B Limited will be called as holder of preference shares. Yeah, they will be called as holder of preference shares. Now, when we need to understand the accounting requirements of the holder, who is the holder? B Limited. When we need to understand the accounting requirements of holder, where do we go? We need to go to Ind AS 109. So for holder, the accounting aspects will be from Ind AS 109. And for this issuer, Ind AS 32 will become the relevant accounting standard, because issuers accounting in terms of whether the preference shares which have been issued will be called as equity or liability or something else. Where is that covered? In AS 32. So you can say this standard is relevant from the issuer's perspective. This standard is relevant from the holder's perspective. Yeah. Okay. Yeah. Please make this a note. Very, very important note. And this is something you'll have to just carry through. Okay. And as we move forward, you will understand its application. Third standard, Ind AS 107. This is all about disclosures. Disclosures in relation to the financial instruments. There's a saying that any company which used to prepare its financial statements under Indian GAAP, let's suppose its financial instruments, let's suppose its financial statements were running into say 30 to 40 pages. Under Ind AS, for the same company, the size of the financial statement significantly increases, almost double up. So you can say, let's suppose if A Limited was preparing financial statements as per Indian GAAP, and the size of the financial statements was 30 to 40 pages. Now, when A Limited will be preparing its financial statements as per Ind AS, the size of its financial statements will be easily 60 to 70 pages. Yeah, almost develops. Now, what is the reason for this? The reason for increase in the size of the financial statements of the company under Ind AS happens to be disclosures. Because under Ind AS, you might have seen this, under Ind AS, under various Ind AS, there are significant, extensive requirements of disclosures. And one of the major contributor to those disclosures happens to be this standard. One of the major contributors to the disclosures in the financial statements as per Ind AS happens to be Ind AS 107. This standard is all about disclosures, only on disclosures, and the disclosures only in relation to these two standards, or you can say only in relation to financial instruments. Clear? Yeah. Clear on various aspects related to three standards which are covered in relation to the financial instruments. Okay. Yeah. Now the next thing which comes to our mind is about the understanding of financial instruments. So far, we have only discussed about the applicability of various standards. We have only discussed about which all standard will be relevant in relation to which party, or maybe from the holder's perspective, issuer's perspective, or in relation to the disclosures. Now let's get on to our understanding about the financial instruments per se. What is this financial instrument that we need to understand in greater detail? All right, yeah. So let's understand about financial instruments. I'll just take you to this definition of financial instruments first of all. Yes, so something which you can see on your screen right now. What is a financial instrument? We can say it is any contract, yeah, that gives rise to financial asset of one entity and financial liability of another entity. Now, for the time being, I would suggest that please ignore these words financial at two places, under financial asset, under financial liability. Please ignore these two words. And then let's try to understand about financial instrument. So I'm just reading this definition again. Okay. So I'm reading this definition now. Financial instrument is any contract that gives rise to asset of one entity. I've just, strike through this part for the time being only. For the time being only, I've removed this word. That gives rise to asset of one entity and liability of another entity. Again, for the time being, I have removed this. Yeah. Now, can you just give me some of the examples that come to your mind which will fit this definition? Please ignore equity instrument also for the time being, financial words under asset and liability, and give me the examples which will fit this definition. And you will then understand that how simple this concept become if we just try to relate some of the things with this financial instrument. Yes, quickly. I'm waiting for the responses. Which all examples will come to your mind when we talk about this definition of financial instrument? Means any contract which gives rise to asset of one entity and liability of another entity. Yes, quickly. Any examples that come to your mind? Yes, I'm waiting for a response. Any contract that gives rise to asset of one entity and liability of another entity. Yes, I understand it's very simple. Yes, quickly. Any examples that come to your mind? Asset for one and liability for another. Okay, very good. So Kostab has responded. Kostab is saying, so it can be about sale of goods and purchase of goods. Yeah. So if I look at that example which Kostab has just mentioned, so we can say debtors. Will the debtors meet the criteria? Or let's look at this definition again. Debtors get generated through a contract. Yeah. So can we say there is a contract? The answer is yes. And do we say debtor is a asset? Debtor is an asset for one entity? That's correct. And will the debtor become a liability for another entity? Of course, yes. Liability for another. So all three conditions are fulfilled? Yes. So very simply, now what do we understand? That debtor is nothing but a financial instrument. And you may be thinking, oh God, we didn't know about it. That is it like debtor is a financial instrument? Yes. See, when we talk about financial instrument, if you might have heard this elsewhere, if you might have covered this earlier, very complex terms, very complex instruments come to our mind. We generally associate financial instrument with any topic which is considered to be complex, which is not true. Financial instrument can be as simple as debtors. Can you see this? It can be as simple as debtors. Yeah. And let me just look at some more examples which I have received. So Ambika is saying So then we can also give an example of creditors. Let's see, will the creditors meet this criteria? Is there a contract? Yes. Will the creditor be a liability for one entity? Yes. And will it also become an asset for another entity? Of course, yes. So creditor is also a financial instrument. Then Bhargav Kesti is saying, sir, sale of assets. Of course, that will also to some extent fill over here. Bharat is saying bonds, promissory notes. Very good. Again, let's understand through bonds. Now, in case of a bond, do we have a contract? Yes, we have a contract. And can we say it's an asset? Yes, the holder will call it as an asset. Yes, of course, it's an asset. And will that become liability for another entity? Yes, it will be liability for the issuer. So this is also a financial instrument. And let me just name other examples which you have shared with me. Bharat is saying promissory notes. Yes. Then Nivedita is saying debentures, of course. Then Nivedita is also mentioned shares. I'll come to that. Devesh is saying bank audit. Yes. Then next example comes from Neha. Neha is saying, sir, credit sales, purchases, borrowings. Of course, they are all financial instruments. Yeah, as simple as that. Now, let me just extend this definition of financial instrument. Okay. For the time being, we kept these two words, financial. I'm just ignoring that still. I'm not covering that aspect still. But another aspect was about equity instruments. So now I'm just bringing that part into the definition. And now with inclusion of this part in the definition of financial instrument, we'll see what more examples can be included under this definition. Okay, so I'm reading this definition once again. Financial instrument is any contract that gives rise to asset of one entity and equity instrument of another entity. Means that will be asset for one and equity or liability for another entity. Now you can just think of some more examples. Though Nivedita has already shared one example around it. Let me just see. Okay, very good. Bhargav has shared one more example. So now when we talk about liability or equity of another entity, so like Bhargav and Nivedita have mentioned, it's about investment in shares, equity shares. So let's understand. Will that become a financial instrument? Investment in equity shares. Now, will that be through a contract? Of course, yes. There will be a contract. And will that become an asset for one entity? Of course, the entity that will invest will become the holder. And for that entity, investment will be an asset. So there's an asset. And will that become liability or equity instrument for another entity? Yes. For the other entity which has issued equity shares, it will become equity instrument. Correct? So that's why if we consider this other aspect of the definition, what do we see? Investment in equity shares are getting covered under financial instrument. All right. Yeah. Then I received one query from Chala. Chala is asking, sir, the standards related to financial instruments are not applicable to construction sector related companies. Please explain. See, financial instruments are not specific to any sector. They apply to each and every sector. So we cannot say that financial instrument will not apply to construction sector or real estate. They will apply to every sector, except for some of the scope exclusions. in relation to certain items or in relation to certain transactions, they apply to all. And there's no restriction regarding application of financial instruments to a construction sector. Okay, clear? Yeah. Okay, great. So Kaustav is saying, sir, investment in subsidiary can also be an example. Yes, that can also be an example. Yeah. Okay, great. So with this, I'm hoping that we are now clear about the meaning of financial instrument. See, in this standard or in this topic, in fact, the way we are going to cover this financial instrument, I'm not really going to specify whether we are covering Ind AS 109 or Ind AS 32. So both of them will just keep applying. Yeah, because both the standards are quite interrelated also in terms of applications of various items. I'll just explain you as we move forward as to why I'm saying they are interrelated to a certain extent. The main point which you need to understand over here is that financial instrument is spread over 3 standards. But for the purposes of our discussion, we'll just keep our discussion as if we are discussing the financial instruments and we are not discussing either Ind AS 109 or Ind AS 32. Both of them will automatically keep getting covered. For the time being, you can say we are just focusing on the definitions. And the very important point is about understanding of all of these definitions. And why I'm saying understanding of all of these definitions. See, there are 4 topics, I would say, under this standard. And this is very, very important for the purposes of your revision also. Financial instrument, financial asset, financial liability, and equity. Okay, these are the 4 topics that I'm talking about. And in terms of the topics, I'm only talking about their definitions. I'm only talking about their definitions. And that's why I need your attention. It will be very, very, very important for you to understand all of these definitions carefully. In fact, very carefully. And if you have iota of doubt in relation to any of these definitions, please ask me. Because if you fail to understand any of these definitions, then the standard will become very complex for you. Why? Because you will not be able to appreciate most of the things in the financial instruments. But if you understand these definitions, then you will see that many requirements of this standard or this topic means overall this set of accounting standards on financial instruments will become very easy for you. Okay, yeah. So that's why you need to really focus and understand all of these definitions carefully. Now, when we discuss financial instruments, I skipped these 2 words, financial under financial asset and financial under financial liability. So that's why it's now important for us to move on to next part to understand what is a financial asset, what is a financial liability. Correct? To understand what is a financial asset, what is a financial liability, because then we will also be able to appreciate this financial instrument in a better manner. All right? Yeah. So what I'm now doing is I'm taking you to the next part, that is about definition of financial asset. And I'm hoping that all of you are clear on the meaning of financial instruments so far. You can please confirm me, and in case you have any doubt, please let me know. Okay, yeah. Bharat has requested, sir, please remove the presentation mode Yes, I'll remove that. Don't worry. Yeah? I'll remove that presentation mode. But for the time being, it's important because the definition is something which you can see on the presentation. You can also refer to the module. In case you want, you can also refer to the module and you can refer to page number 12.7. Page number 12.7 of the module. All right, all of you? Yes. So now, moving further on to the meaning of financial asset. What is a financial asset? First, it is cash. So in case we talk about cash, cash will also include bank balance. So in case we talk about cash or bank, that is nothing but a financial asset by default. You don't need to get into any definition. Clear? Yeah. Number two, equity instrument of another entity. Means if a company, if a person, if an entity invests in equity shares of another entity, then the company which has invested will call it as an investment. And because this is equity instrument of another entity, that's why this investment will be called as financial asset by default. So the first two parts which you can see on the presentation, cash and equity instrument of another entity, they are by default forming part of the meaning of financial asset. So we don't need to get into the definition. So within the definition, they are automatically covered. They are directly covered. Okay. Yeah. Clear on these 2 points? Now moving on to the third point, which is now extremely important and which is the key to understand financial assets. So what is a financial asset? Other than these two, what we have discussed, a contractual right to receive cash. For the time being, I'm just removing 2 words, financial asset. Okay, these 2 words, or in fact, this part for the time being, I'm just ignoring. We can just simply understand that a contractual right to receive cash from another entity. And can you give me some examples which will fit this criteria now? Yes, quickly. Can you give me some examples which will fit this criteria now? So what do you think will be a contractual right to receive cash from another entity? Yes, quickly. Contractual right to receive cash from another entity. Now I can remove this presentation board because I'm sure you will share many examples with me which we can discuss. Yes, quickly. So what did we say? That we need to have a contract, number 1, and through the contract there will be a right to receive cash. So which all examples will fit into this criteria? Great. Bhargav is saying, sir, same example. Let's take it. What is that? Debtors. Sure. So let's test debtors. Let's test whether debtors will become financial asset or not. Okay. Do we have a contract for debtors? Yes. And do we receive cash through debtors? Of course, yes. So therefore, what will happen? Debtor will be a financial asset. Any other example that comes to your mind? Quickly. Okay, Costa is saying some cash sales. That is, of course, true. Loans given. Then Rohit is saying sale of goods. Okay. Shalini is saying some bills receivable. Of course. Yeah. So let me just bring in one more example like shared by you. Loans given. So these are loans given. So do we have a contract in case a loan is given to another party? Yes, there will be a contract. And will that money come back after a certain period? Of course, yes. Money will come back after a certain period. So that's why this will be received in cash. So that's why loans given will also become financial asset. Clear on this? Yeah. Easy, simple to understand. What do we mean by financial asset? All of you? Okay. Now, let us understand certain more aspects around it. Whenever we talk about financial asset, you always need to understand that financial asset has to be an asset always. See, we did not start our understanding with whether an item is an asset or not. That is given. That is by default there. We have just begun with the understanding that asset was always there. So what was the objective? Objective is really to classify that asset into financial or not. Correct? Yeah. So whenever you will have to test financial asset, so you need to always remember that it has to be an asset first of all. Because if that will not be an asset, it cannot become financial asset. Clear? Yeah. Now with this, another important point which can just relate to some of the practical world. Now this will not be required to be applied by you anywhere in terms of your exams, but practically let's see how things really work. In the balance sheet of a company, all the assets will be required to be classified into two categories. I'm saying all the assets. All the assets mean all the assets of the company into two categories: financial asset and non-financial asset. Financial asset is something that we have been discussing. We understand what is a financial asset, but we have not discussed anything about non-financial asset, and we are not going to discuss because there is no definition of non-financial asset. So any asset which will not become a financial asset will become non-financial asset. So what is a non-financial asset? Which is not a financial asset. Very simply. Okay, clear on this? Yeah. So let me just now bring in one example and let's just see whether that asset will become financial asset or non-financial asset. So that's the question for you, all of you. Yeah, because we are clear with our understanding of financial asset. So we understand financial asset is cash, equity instrument of another entity, and third was about this definition. Okay, applying these three only, you need to tell me whether this example, that means PPE, will be a financial asset or not. Yes, quickly, over to you. Over to you. Do you think PPE, property, plant and equipment, is a financial asset or not? Yes, I'm waiting for a response. Quickly, tell me, will you call this as a financial asset or not? Yes, quickly, I'm waiting for a response. Huh? Will you call this a financial asset or not? And you need to apply the same principles, huh, please. Same principles. Remember, the definition of financial asset, and applying the definition of financial asset, you need to tell me whether it will be financial asset or not, and give me the reasons. While you answer, it's very important that you give me the reasons. Give me the reason why will you call it as a financial asset or not a financial asset. Okay, Ashita is saying it's not a financial asset as there is no contract to receive cash. Okay, Ambika is saying, sir, it's not a financial asset. Okay, Rohit is also saying no, Naveen is also saying no. Let me just see what others have to answer on this. Bharat is saying yes, sir. They can be called financial asset when you have lend them on lease to another entity. So I'm just keeping it very, very simple. PP, will you call it as a financial asset or not? No if and buts or no when, etc. Nivedita is saying it's not a financial asset. So let's understand. In case of PPE, can we say it's cash? No, it's not cash. Can we say that it is equity instrument of another entity? No. Can we say that there is a contract to receive cash? No, because for PPE, what do? PPE will be used in the business for production purposes, for administrative purposes. You remember the definition of PPE as per Ind AS 16? Yeah, it does not meet any of these criteria. So if it does not meet any of these criteria, can we call PPE as financial asset? No. Why? Because it does not meet the definition of financial asset. So what will PPE become? PPE will therefore become non-financial asset. Okay, clear on this? What will PPE become? Non-financial asset. Yeah, okay. Next aspect is around certain more assets wherein we don't receive cash, and instead of cash, what do we receive? Goods or services. Let's understand how. So let's suppose advance has been given to vendors. An advance has been given to vendor. And why will you give an advance to the vendor? So that the vendor can supply goods or services against that advance. And later on, this payment will get adjusted against those goods or services. Yeah, that's the objective always. In case there is any default by the vendor, then this advance may be refunded. That's the general principle on the basis of which advance to vendor works. Now, let's try to check whether this advance to a vendor should become financial asset or not. So let's see. Now, can we say there is a contract? The answer is yes. There is a contract. That's why advance has been given. So this condition is fulfilled. And can we say that through this contract, let's think about it. When you give advance to vendor, so will you receive the cash back? No, you will not receive cash back. Instead, what is it that you will receive? Goods or services. So because we are receiving goods or services, because we are not receiving cash, that's why, will it meet this criteria? No, this will not meet this criteria. And that's why this asset will not become a financial asset. Yeah, that's why this will not become a financial asset. Because what is it that we need to receive? We need to receive cash. If we are not receiving cash, it's not a financial asset. Clear? Yeah. Okay. Another example. So I'm just giving you various examples, and next thing will be wherein I'll test your knowledge. So very soon I am going to take you to an example wherein I'll test your knowledge. Okay. Next, let's suppose advance tax has been paid. You all understand about advance tax? Taxes have been paid in advance. Advance tax is about income tax. Okay, so we have paid advance tax. Now, in this case, when the advance tax has been paid, can we say there's an asset? The answer is yes, there's an asset. Why? Because if you have paid advance tax, that is nothing but an asset. So there are certain economic benefits which are attached to it. Yes or no? Okay. Now the question arises whether this advance tax can be called as a financial asset. And for an asset to be called as a financial asset, what do? We need to look through the requirements of the financial asset. It should either be cash. So this is definitely not a cash. It should either be equity instrument of another entity, which is again not the case with advance tax. So that's why we need to get onto this criteria. And in this criteria, two conditions are mandatory. One, there should be a contract, and holder should receive cash. Holder should receive cash. Now tell me about advance tax, whether you will call it as a financial asset or not. I think I missed certain responses. Vaibhavi, Divesh, Kaustubh, Neha, Gomti, they all responded earlier. Okay, great. So can you now answer about advance tax also quickly? Will you call this as a financial asset or not? Quickly. Yes, quickly. Will you call this as a financial asset? Yes, quickly. Okay, Neha is saying, so it's not a financial asset. Okay, why? Can you also give me the reason why will you not call it as a financial asset? Yes, I'm waiting for a response. Kaustubh is also saying it's not a financial asset. And any reason for this? Because, okay, great. So Ashta is saying, sir, there's no contract. It is statutory liability and no cash will be received. But there's no liability over here. There's no liability, it's an asset. So what do we say? That this amount has been paid as per the statutory requirements. Correct? So your point is absolutely correct. That because this payment has been made as per the requirements of statute and not the contract. So that's why the first condition which we wanted, which is a necessity for a financial asset, existence of a contract, is missing. And if the contract is missing, can we call it as a financial asset? No. Do we need to check this criteria? Of no use. Because for a financial asset, both the criteria are required to be fulfilled. Okay, clear? Clear on this financial asset? In the definition of financial asset, there was another part which I removed. So you can just add it to the definition. A contractual right should be to receive cash or another financial asset from other entity. So means from the other entity, we can either receive cash or another financial asset. For a financial asset to be called as a financial asset. Or you can say an asset to be called as a financial asset. Clear? Yeah. So what we can now do is, so I missed responses of Naveen. Naveen also mentioned it's not a financial asset. And Neha has given me the reason. Very good. Neha is saying because sir, there was no contract. Great. Weberly has also given the same answer. Very good. Okay, so now what we can do is we can now move on to some examples. Let's look at some illustrations now. Okay, so next example. Prepaid expenses. What do you think about prepaid expenses? Quickly, yeah? Will you call this an asset to be covered as financial asset or not? So prepaid expenses, will this be a financial asset? Yes or no? Quickly. Will you call this as a financial asset or not? Yes, quickly. Prepaid expenses. So should we check it whether prepaid expense will become financial asset or not? Yeah. Okay. So do we have a contract? Do we have a contract in case of prepaid expenses? Yes. For example, prepaid insurance. There's a contract. Next, through this contract, do we receive cash or another financial asset? Through this contract, do we receive cash or another financial asset? No. What do we receive? We receive services. In case of insurance, we are receiving services. So that's why other condition is not fulfilled. And that's why this will not become a financial asset. Clear? Yeah? Okay. Another example. In fact, I have got some examples on the screen, so which you can use now. So let me just take you to those examples. Okay, if you can just look at example number 4. Okay, on your screen, if you can just look at example number 4. Investment in perpetual debt carrying interest at fixed rate. And please don't go by the response which is given. It may be wrong also. Yeah. So let's think about it. If we invest in perpetual debt and the debt carries interest at fixed rate, Can we say it's a financial asset? Tell me. Can we say it's a financial asset? Perpetual debt means principal will remain invested till perpetuity. It will not come back. Only the interest will keep coming. Principal will not come back. Only the interest will keep coming. So what do you say in that case? Will that be a financial asset or not? Tell me the reason. Huh? When you respond, give me the reason. Yes, quickly. Point number 4, which you can see on the screen. Will you call this a financial asset or not? Yes, I'm waiting for a response. Huh? Will you call that as a financial asset or not? Yes, quickly. Will you call this as a financial asset or not? You need to give me the reason. Huh? Okay, Bhargav is saying yes, sir. It's a financial asset. But Bhargav, can you give me the reason why you are calling this as a financial asset? I'm waiting for a response. Why you are calling this as a financial asset? Because principal is not going to come back. So if the principal is not going to come back, then why do you think it will be a financial asset? So Neha is saying, so it's a financial asset, first of all, because there's a contract, okay? And the contract will give the right to receive cash in the form of interest. Ashita is saying, sir, it's in the nature of equity instrument, which can again be one of the perspectives which we can discuss in more detail, Ashita, as we move forward. And you are definitely, there. You are definitely up to the point, which is in the context of equity instrument. Now let's look at it from the holder side. Now from the holder side, do we have a contract? Yes, we have a contract. And through the contract, do we receive cash? Now cash has got two components. One is to receive principal, second is to receive interest. In this case, principal will not come back, but the interest will keep coming till perpetuity. And mathematically, I'm saying mathematically, if we compute interest till perpetuity, and if we compute its present value, then what will you see? You will see that the principal is also covered there. Yeah. So what are we receiving? We are receiving cash in this instrument. So that's why this will also become financial asset. Clear? Yeah. Clear on this? Then Divesh is saying, yes, sir, it's a financial asset and we will receive cash in the form of interest. Very good. Naveen has the same answer. Neha Sharma has the same answer. Costa, Pujita, great. So all of you are there. Bang on. Bhargav is saying, yes, sir, there is a receipt of interest. So that's why it's a financial asset. And Pujita is saying, yes, because interest is something that we are going to receive. Okay. Yeah. Now let's move on to the next part of this definition. Contractual right to exchange financial assets or financial liabilities under favorable conditions. So the definition of financial asset is not limited to only these 3 points that we have discussed. Fourth point is there, and after that, fifth point is also there. So I'll go to the fifth point later on. We don't need to get onto the fifth point right now. I'm calling this to be a fifth point. So we can go to this later on, not now. So I'm now talking about this point. To exchange financial assets or financial liabilities under favorable conditions. So what does it mean? I think the best way to understand this part of the definition will be to look at this example. And with the help of this example, we can get clarity around the favorable conditions under which a contract can become a financial asset. Let's suppose A Limited has an option to buy shares of B Limited. Option means if A Limited wants, it may buy, otherwise it may not buy. Correct? Now, in relation to this option, A Limited can buy shares of B Limited at rupees 45 per share. Yeah. Currently, the share price is, let's suppose, rupees X. At a future date, let's suppose somewhere over here, share price of B Limited becomes rupees 50 per share. So share price of B Limited is 50 and A Limited has an option to buy this share at rupees 45. So that's why, will this option be favorable to A Limited? Yes or no? Will this option be favorable to A Limited? Yes. Why? Because in the market it's available at 50 and A can buy it at 45. So that's why this will be considered as a financial asset. Clear on this? Yeah. Clear on this second part of the definition? Now there is another part of the definition which I have told you to park it. So when we'll move further, when we'll talk about equity versus liability in greater detail under Ind AS 32, that is when we'll pick it up. Okay? Yeah. Now we are moving on to the next definition, financial liability. And we have been spending significant time on these definitions, for which I have told you the reason. And that's why it's very important that if you have any query in relation to any of these definitions that we have been discussing, please let me know. Yeah. Please don't hesitate to ask, because all of these definitions will be crucial for your understanding around recognition and measurement later on. Okay. Now we are moving on to financial liability. Understanding of financial liability hopefully will now become easier for you, because you need to just look at the opposite side. So what was a financial asset? For a financial asset, the opposite side, the opposite party is something that we are checking now. And we are now checking whether a liability will become, yes, yeah, okay. Am I live now or okay, yeah. नहीं, keep it full size and I'll just keep removing the PPT. Please put me on hold for some time. Hi, welcome back. Sorry for some interruption. There was some technical glitch. Okay, so we were talking about financial liability. So, in relation to liability, now what do we need to check? Whether that liability will become financial liability or not. Yeah. So, that means once again, we need to go with an understanding that liability is there. We don't need to check whether liability exists or not. So liability is already there. And in case the liability exists, what do we need to check? Whether that liability will become financial or not. Now, for the purposes of financial liability, again, we have the same criteria, but we are just now going to look at it from the opposite side. So, what are those two conditions which we considered for financial asset? Existence of a contract first, and therein this contract used to give right to receive cash, and now because we are talking about a liability, so can we have a right? No, now there will be an obligation. So now instead of right, there will be an obligation, and now we will not receive cash, instead we will pay cash. So obligation to pay cash. Okay, so looking at these two opposite sides, now we need to test, we need to check which all liabilities will meet this criteria, and in case they will meet both the criteria, then those liabilities will become financial liabilities. All right, yeah. So can you give me some of the examples, and I am also starting with some of the examples. Let's test creditors. Will the creditors be called as a financial liability or not? Creditors. Now, in case of a creditors, do we have a contract? Yes, we have a contract. And through the contract, will there be an obligation to pay cash? Yes, there will be an obligation to pay cash. Because how do we settle the creditors? We settle the creditors by paying cash. So that means there is an obligation to pay cash. So because of this, what will happen? Creditors will become financial liability. Any other example? Yes. You can give me any other example for financial liabilities. Great. So Bhargav is saying, sir, debentures. Sure, let's test debentures. And Bhargav is saying, sir, we need to test it from issuer's perspective. Of course, that means a company which has issued debentures. We need to check for such company whether debentures will become financial liability or not. So in case of a debenture, do we have a contract? Yes. And through this contract, will there be an obligation on the part of issuing company to pay cash? Yes, there will be an obligation to pay cash. Both the conditions are fulfilled, so that's why debentures will also become financial liability. Any other example that comes to your mind? Great. Ambika is saying, sir, similarly, loans repayable, they can also be an example. Yes. Kaustav is saying, sir, bank loan. Yes, bank loan can also be an example for this. Haresh is saying loan taken. Yes. So any of the borrowings which will meet any of these criteria, which will meet both these criteria, will therefore become financial liabilities. Okay. So let's look at one more example. See, if we talk about GST liability. GST liability. So a company which has sold goods, which has rendered services, they must have collected GST from the customers, and against that, they would be required to pay GST every month. Yeah. Now, in relation to GST liability, or this GST which is payable, we need to check whether it will be called as a financial liability or not. So let me just see. What do you think about GST liability? Yes. Will you call GST liability as a financial liability or not? Quickly. Will you call this as a financial liability or not? Yes. GST liability will become financial liability, yes or no? Yes, quickly. I'm waiting for a response. Will you call this as a financial liability or not? Okay, Ashita is saying no, sir. It's there's no contract, so that's why it will not become a financial liability. And Bhargav is saying, sir, because it's a statutory obligation, it's not a contractual obligation. So what do we see for a GST liability? Is there an obligation to pay cash? Yes, there is an obligation to pay cash. There's no doubt cash will have to be paid, but where does this obligation arise from? How does this arise? So is it arising from a contract? No. So can we say company and the GST department have a contract? No, they don't have a contract, but it's the statutory requirement. So that's why we will say this condition is not fulfilled. And because there's no contract, so that's why can we say GST liability is a financial liability? No. In such a case, what do we say about GST liability? In such a case, it will be non-financial liability. It will be non-financial liability. Okay, yeah. So same perspective is required to be considered in case of financial liabilities. Something that we discussed in case of financial assets. Yeah, but it's the opposite side that we look at now. Okay, clear on this? Other part, similar to what we discussed in case of financial assets. In the balance sheet of a company, all the liabilities will have to be segregated into two categories. One, financial, second, non-financial. And how do we define non-financial? A liability which is not a financial liability will become non-financial liability. Okay, yeah. A liability which is not a financial will become non-financial liability. So that means every time we'll have to check whether an asset will be financial or not, whether a liability will be financial or not. In case those are not financial, then they will become non-financial. So there is no criteria to check them as non-financial first of all. Okay. Okay, so now similar to what we discussed in case of financial asset, we have another part of the definition of financial liability which we can see on the screen right now. So what is this part? So we have discussed that contractual obligation should be there to deliver cash or another financial asset. Okay, let's move on to the next part. Next part is about this. Means to exchange financial assets or liabilities under potentially unfavorable conditions. And let's look at one illustration. I think we can understand this in a better manner with the help of one illustration. Yes. So again, going back to our example, wherein A Limited had an option to buy shares of B Limited, and the option allowed A Limited to buy shares at rupees 45. Let's suppose the share of B Limited is rupees 40. Now in this case, will this option be favorable to A? No. This is unfavorable to A. And because this is unfavorable to A, so that's why what will it become? It will become financial liability. Clear? Yeah. Now moving back to the definition. So this part, again, as we discussed in case of financial assets, this second part of the definition will cover later when we'll talk about difference between equity and financial liability as we move forward. So you can just park it. You can just mark it. This part of the definition will cover slightly later. Okay. Yes, moving on to the third definition. Third definition is about equity. Equity is something which is very, very common to us. We all understand equity as equity shares. Yeah, so that's the understanding in our mind in relation to equity. But now we'll just see that equity is not really limited to equity shares. It goes beyond that. And that's the context that we need to understand in relation to this definition. So what is equity? Again, if you look at the definition of equity, it says any contract that evidences a residual interest in net assets of an entity. Means again, there has to be a contract. So if equity has to be there, contract is a must. Secondly, it talks about residual interest in the net assets of an entity. So if there will be a residual interest in net assets of an entity, then the instrument will become equity, otherwise not. So let's see, what do we mean by this? Say there's a company A Limited, okay, which has issued shares or you can say which has issued equity shares to B Limited. Now in this case, B Limited is the holder of equity shares and A Limited is the issuer. Now, because the company has issued equity shares to B Limited, can we say that A Limited will carry any obligation to pay cash to B Limited? Let's understand. Or in simple terms, what do we need to check? In simple terms, we need to check whether these equity shares are a financial liability for A Limited. The moment I ask this question, I'm sure the answer is ready with you, because you all understand that because these are equity shares, that's why you may be thinking, sir, how can they become financial liability or how can they even become liability, which may be right. But let's understand the reason. Let's understand the reason why we don't consider that to be a liability. See, when an investor has invested in equity shares of a company, can we say that the company will be obliged to pay cash to that investor? No. And when will this obligation arise? At the time of liquidation of the company. Because when A Limited will get liquidated, let's suppose at some later date, at some future date, when A Limited will get liquidated, only then its shareholders will receive something out of A Limited. And if the amount of equity share capital, let's suppose, is 1 lakh. Let's suppose this amount is 1 lakh. Now, first of all, we have understood that A Limited is not obliged to pay 1 lakh to B Limited at any point of time. There's no obligation. If A Limited wants, it can pay dividend to B Limited. But if A Limited doesn't want, it may not pay dividend to B Limited. Second, even at the time of liquidation of A Limited, will it be mandatory for A Limited to pay 1 lakh to B Limited, which B Limited has invested? Again, that will depend. A Limited may pay more than 1 lakh, may pay 1 lakh or less than 1 lakh. That will depend on the residual interest or whatever resides in A Limited at the time of liquidation. Means after paying off all the creditors, after paying off all the third party liabilities, whatever will get left in this company will be given to whom? Equity shareholders. Yeah. And which may be 1, less than 1 or more than 1. What do we call it as? Net residual interest. So an instrument that entitles holder to the net residual interest in a company is therefore called as equity. So we are saying that entitles to net residual interest. Okay, yeah. Now equity is something common to us, very, very easy for us to understand. Let's take some more examples. Yeah. See, instead of equity shares, A Limited issued convertible preference shares to B Limited. Yeah. So B Limited is the holder of these preference shares and A Limited has issued these convertible preference shares to B Limited. Now in this situation, we need to check whether these convertible preference shares will become liability, will become financial liability or non-financial liability, or can they also be called as equity? Yeah. Now, for us to assess whether they will be called as liability, what are the conditions? There are two conditions. When I'm talking about liability, I'm talking about financial liability right now. First of all, there has to be a contract. So do we have a contract in this case? Yes, there's a contract. Secondly, through the contract, will there be an obligation on the part of A Limited to pay cash to B Limited? Will there be an obligation on the part of A Limited to pay cash to B Limited? The answer is no. Why? Because if we look at this instrument, preference shares which have been issued today, after some time, they will be converted into equity. So there's no payout of cash, number one. And when they will be converted into equity shares, again, for equity, there will not be any obligation to pay cash. Because for equity shares, what do we know? There's no obligation. Till the time of liquidation, there's no obligation. Even at the time of liquidation, there's no obligation to pay the fixed amount. That will depend on the net residual interest. So in this case, this instrument, can we say will become a financial liability? The answer is no. It will not become a financial liability. So in case it will not become a financial liability, what will it become? Equity. It will become equity. And though we have tried these two conditions, though we have tried to check whether these two conditions are fulfilled, and we have checked that it will not become a financial liability, and wherein we have found that yes, it's true, it will not become a financial liability. But let's also check whether it will become equity or not. For equity, what do we need to check? That instrument should entitle instrument. What's the instrument? Convertible preference share should entitle holder to the net residual interest in A Limited. So let's see, is that happening right now? Now in this case, B Limited will be entitled to net residual interest. Why? Because can B Limited ask A Limited to pay cash against these instruments? No. Because after a certain period, preference shares are not required to be redeemed. Instead, those are required to be converted into equity shares. And when those will be converted into equity shares, again, B Limited will not get cash till the time of liquidation of the company. And even at the time of liquidation of the company, B Limited will get only something which is left in the company. So whatever is left in the company will come to B Limited. Okay. Yeah. So that's why this instrument will therefore be called as equity. Yeah. Okay. So I have this, I think, query from Bhargav. So Bhargav is asking, so since conversion of preference shares to equity shares is in the hands of the holder, how can we conclude that there will be no cash outflow? What if shareholders disagree to convert the shares? So just for your understanding, I did not put a condition that this conversion is in the hands of the holder. I just said that these are convertible preference shares. Okay. So I did not give any option to any of the parties to convert. So I'm saying after a certain period, they will automatically be converted into equity. So that was the understanding about this instrument. Of course, if the facts will change, if the terms and conditions will change, then the instrument will have to be assessed in a different manner. So we are just keeping it very, very simple for the time being. We are saying this is automatically converted into equity after a fixed period. That's the understanding. Clear? Then Rohita is saying, so till the preference shares are converted, there's obligation to pay dividend. Then till that time, why can't this be a financial liability? See, till the time they will remain as a preference share. Again, if you look at the legal requirements in case of preference shares, we are not sure that whether these are cumulative preference shares or not. Preference shareholders get preference over equity shareholders in terms of the dividend payment. Yes or no? As per the legal requirements. So I'm not getting into the contract. I'm just getting as per the legal requirements. And it is not necessary for a company to declare dividend every year. We all know this. So in case the company will declare dividend on equity shares, they will pay this to preference shares also. But what if the company does not declare the dividend? So is it mandatory on the company to pay dividend to preference shares? Till the time these are non-cumulative, there is no mandate. That's why again, what do we say? that this is something which is in the hands of the company, hands of the issuer, or within the control of the issuer to pay dividend or not to the preference shares until unless preference shares are cumulative. Because in case of cumulative preference shares, that gets accumulated. So you can just say that these preference shares are non-cumulative. So that's why again there's no obligation to pay cash even till the time they will remain as preference shares. Okay, clear on this? Yeah. So idea here is to just get on to our understanding of equity as to which all instruments will become equity and what are the ways through which those instruments can become equity. Because it's not necessary that now under Ind AS we will only have equity shares as the equity instrument. You can see that even the preference shares which are convertible, they can become equity shares, or sorry, equity instruments, which will meet these criteria which we have just discussed. That will also become equity instrument. Okay, yeah. So I can take one more example now. Let's suppose there are convertible bonds. Again, convertible bonds mean that after a fixed period, bonds will be converted into equity. And let's suppose no interest payment is mandatory on these bonds. No interest payment is mandatory on these bonds. So in this case, do we say there is a contract? Yes. But is there an obligation on the part of issuer to pay cash? No. So that's why, will it be a financial liability? No. If you look at the legal form of the bonds, what do we call bonds as? Liabilities. If you look at the legal form, bonds will be considered to be a liability. But now in this case, we are going beyond the legal form. So we are looking at the substance rather than legal form. And in terms of substance of this instrument, what do we see? We can see that after a fixed period, this bond will convert into equity, or you can say equity shares. And when it comes to the equity shares, then the holder will not be getting cash from A Limited. Or what will the holder get? Net residual interest in A Limited. So same is the case for this instrument also. So that's why, what will this instrument become? This instrument will also therefore become equity. Now this is what Ind AS requires you to do. Ind AS requires you to look at the substance and not limit yourself to the legal form. Because if you look at the legal form, you will automatically call that instrument as liability. But we can see that this instrument is not a liability. Instead, this instrument has become equity. And this has to be treated like equity. Okay. All of you clear on this? Clear on the meaning of financial asset, clear on the meaning of financial liability, and clear on the meaning of equity? And therefore, clear on the meaning of financial instruments also? Yeah, any questions from your side on this? Any doubts in case you have on this, please let me know. Any questions, any doubts in case you have? Any questions, any doubts? No further questions on this? Okay, so then what we will now do is we'll now start with the financial assets in terms of their recognition and measurement. Yeah. So we'll now be discussing only about financial assets. So now we are actually getting into their accounting requirements. We'll see how they are recorded in the financial statements and what is the amount at which they will be measured in the financial statements. As a rule, every financial asset at the time of its initial recognition will always be measured at fair value. So every financial asset at the time of its initial recognition will always be measured at fair value. And we can just take one example of security deposit. In case of a lease. So in case of a lease, we are just taking example of security deposit. Okay, that means security deposit given in case of lease. So security deposit given in case of lease, whether this will be a financial asset or not. Yes, it will be a financial asset. Why? Do we have a contract? Yes. And through this contract, do we receive cash? Yes. At the time of end of the lease term, we will get cash. That's why security deposit, or we can say lease deposit, will be a financial asset. Okay. Now, when it comes to measurement of financial assets, so one aspect is about initial recognition, initial measurement, which we have seen. So it's initial recognition, measurement is something that we've just discussed. It has to be at fair value. Another part is about subsequent measurement. So this is fair value. Another part is about subsequent measurement. What do we mean by subsequent measurement? Let's suppose security deposit was paid on 1st of May 2020. Yeah, and lease deposit is paid for 3 years. So now at year end, 31st March 2020, at year end, at what amount this security deposit will be measured? So first measurement of security deposit will be on 1st of May 2020 and its subsequent measurement on 31st March 2021 will be driven by different requirements and for which classification is required. So we can say it's dependent on classification of financial assets. So what do we mean by this? On 31st March 2021, how do we need to measure, at what amount we need to measure security deposits will be dependent on the classification of security deposit. So that means now for us to understand about the measurement of security deposit, measurement of financial assets, we need to first of all understand their classification. Clear? Yeah? Clear on this? So when we look at the classification of financial assets, that means that classification is relevant for their subsequent measurement only. That is not relevant for their initial measurement. Okay? Yeah? So now I am getting on to the classification. So how do we classify financial assets? Financial assets can be bucketed into three categories. One, at amortized cost. Second, under fair value. And under fair value, there are two more buckets. Fair value through OCI, fair value through P&L. So you can just say that these are the names of the buckets. These are the names of the categories under which financial assets may be classified. So there are three categories. First category is called as measured at amortized cost, very commonly known as amortized cost. Second category is known as fair value through OCI. OCI you all know, other comprehensive income. And third category is known as fair value through P&L. P&L is statement of P&L. Now, we need to check which all financial assets will fall into this bucket, which all will fall into this bucket, and which all will fall into this bucket. And depending on their classification into these buckets, their measurement will happen at subsequent date, or you can say their subsequent measurement will happen. Yeah, clear? Clear on the perspective that we are now going to discuss, and why is this classification relevant, and how will this classification impact the measurement of the financial assets? Yeah, okay. So we'll begin with amortized cost, and then we'll get on to these two buckets. And we can just get on to this discussion after the break. Yeah. So I can just now look at some of your queries, and after discussing your queries, we can take a break, and then after the break, we can just come back to this classification, please. Ambika is saying, sir, that means on initial recognition. So she's talking about that convertible bonds example. Means on initial recognition, convertible bonds will be treated as equity instrument. Yes. They will be treated as equity instrument. They will not be treated as liabilities. Neil is asking, sir, how can initial recognition be made without any further classification? Why no classification is required at initial recognition? See, it's not about initial recognition doesn't require any classification. Let's understand this. In our example, security deposit was paid on 1st May 2020. Correct. Security deposit was paid on 1st May 2020. And we are saying subsequent measurement will happen on 31st March 2021. Okay. This is the date when subsequent measurement will happen. Now, when this security deposit will be measured initially on this date, this will always be at fair value. So that's why we don't need to get into the classification to check whether this should be measured at amortized cost or fair value through OCI or fair value through P&L. That will always be fair value. Though it doesn't mean that will not do the classification of security deposit on this date. Classification will also be done on this date. So that means on 1st May itself, we will categorize this security deposit into any of these categories. We'll check whether this will be at amortized cost or fair value through OCI or P&L. But irrespective of any of these bucketing, irrespective of any of this classification, its measurement is always at fair value. That's the point. Yeah, so that's why I'm saying classification will not have any impact on the measurement at the time of initial recognition. Now clear on this, Neil? Yeah. Okay, so with this, we can take a break for 10 minutes now. And after the break, we will continue with our discussion on the classification of financial assets. Okay. Yeah. Hi, welcome back. So we can now continue with our discussion. So now we are going to discuss about the classification of financial asset, which we said can be of three types: amortized cost, fair value through OCI, fair value through P&L. And in the meantime, I also received a query from Neil. So Neil is asking, so that means the thing that we concluded, that these classifications of financial assets are for the reporting date only to determine their carrying values. Yes, these are meant for presentation of the financial assets. Secondly, they are also meant for their subsequent measurement. Okay. Challa is asking, sir, what is the exact meaning of payable in cash? Which may mean that even payable amount, we may pay even 1 rupee. So that affects the definition of financial liability. See, the payable means the amount is certain, and whatever is the contractual amount, that will have to be paid in cash. Let's take one simple example of a lease deposit payable. See, lease deposit payable is rupees 50,000. Now in this case, if we have to check whether this will become financial liability or not, we need to check whether this 50,000 will be payable by the issuer or not. Because if the issuer will not be required to pay 50,000, then this will not be a financial liability. But if the issuer will be required to pay 50,000, yeah, so there's no option through which he can avoid payment of this 50,000, then it will become a financial liability. So that means this contractual amount is evaluated, whether this will have to be paid or not. And you can just not say that out of this amount, some amount is payable and some amount is not payable. That is not how the generally contract works. If the contract is such, then such cases are also required to be evaluated, for which we'll have a discussion later on when we'll discuss about compound financial instruments. Okay. Now coming back to the query of Neil, let me just quickly explain you as to how these are presented in the financial statements or in the books of accounts for the purposes of measurement. So we are saying that first of all the assets are required to be broken into two categories. What are those categories? Financial assets and non-financial assets. Yeah. So under financial assets, now we will have three categories. What are those three categories? Amortized cost, fair value through OCI, and fair value through PL. Under non-financial asset, we don't have subcategories. It's one. Okay. Now, if you look at the chart of accounts, if you look at the trial balance of a company, which includes all the account codes, then each and every item which is recognized as asset will have to be bucketed into these two first of all. And once that has been bucketed into financial asset, that will have to be subgrouped into these categories. So it will work something like this now. So we have assets, then we'll say the group, and then subgroup. This is only for the purposes of your understanding. This has nothing to do with your examination. Let's say PP. This will be one account code. Where will you take it? You will say it's non-financial asset. And over here also it will remain non-financial asset. Yeah. Then let's suppose you have trade receivables. This will be financial asset. Now under financial asset, under subgroup, where will you take it? Let's suppose, I'm just assuming, let's suppose this is amortized cost. So we'll say amortized cost. Then let's suppose this lease deposit receivable. There again, what will you call it as? Financial asset. Under financial asset, let's suppose this is amortized cost. You will say amortized cost. Let's suppose another item is investment in shares of Neil Limited. So this is a financial asset. So we'll say financial asset. And let's suppose this is bucketed under fair value through P&L. So we'll say it's fair value through P&L. Yeah. So that is how its classification will happen. That is how its classification and presentation will happen. And the measurement will be driven by this grouping. And of course, by this grouping. Because the way financial assets are measured are different from the way non-financial assets are measured. And we'll just understand, first of all, how all of these financial assets are measured. And then you will be able to compare it. How the measurement of financial assets will be different from measurement of non-financial assets. So let's get done with this discussion first of all. Then you will get more clarity around it. Okay. Clear on this, Neil? Challa is then asking, Challa is saying, sir, in the lease example, at the time of booking liability, we may think that payable in cash or through any other financial instrument, later on original mode of settling the liability other than financial instrument mode. So he's saying that terms may change, or the settlement could be in a different manner. Please explain the consequences of this. So definitely, I think a lot of your questions are around those topics which are discussed, which will be discussed at a later point of time. So all of these aspects, all of these your queries will automatically get answered. So far, please understand that we have just started with financial instruments and we are discussing the very basics of the financial instruments. There are a lot of things which will have to be discussed, and all of these aspects which you have asked me are automatically going to get covered when we'll talk about all of these things in terms of their subsequent measurement, etc. Yeah, we'll have to wait for some time, maybe 1 or 2 sessions you'll have to wait, and then these queries will get answered. Okay, Chandra? Okay, now we are beginning with checking the classification of financial asset, for which certain criteria are required to be checked, certain tests are required to be made. So what's the first thing? Business model. We need to understand what's the business model of the entity. Is the business model of the entity to hold the financial asset to collect? So we are saying hold to collect. Number 1. Number 2, when this will be held to collect, when the financial asset will be held to collect, so will it collect or will it give rise to contractual cash flows? Contractual cash flows which meet the criteria of SPPI. Okay. So there are few terms that I have used and which will be not easy for you to understand if you just go by the terminologies. So let me just bring in one example, because with the help of this example, this can be understood in a better manner. Let's say a company has got debtors. Okay, company has got debtors. And what's the amount of debtor? Let's suppose 100 rupees. Yeah. Now we need to check whether debtors will be a financial asset. We have checked it. Yes, they are financial asset. Now next step, we need to check under which bucket they will fall. Amortized cost, fair value through P&L, fair value through OCI. So first of all, we are checking whether debtors will fall under the first bucket, that means amortized cost or not, for which we need to check the business model of the company, the business model of the entity. The business model of the entity should be that the financial asset should be held by the company to collect. That means debtors should be held till the time of their maturity. Now, in case of debtors, you may be thinking, sir, what is the maturity period? So debtors will also have a due date after which they get collected. Yeah, so you can just for the time being say that is their maturity period. So if the contract requires that the debtor should make the payment within 30 days, that means company is waiting for 30 days for this 100 to get collected. And that model of the company is called as hold to collect. Means what's the business model of the company in relation to this financial asset? Hold to collect first. Yeah. Number two. Now, when the company is holding this financial asset to collect, so what is it that the company will collect? Company will collect cash, or you can say cash flows, which are as per the contract. That's why those will be called as contractual cash flows. Those will be called as contractual cash flows. And what is the contractual cash flow in this case? 100 rupees. In this case, contractual cash flow is rupees 100. Okay. Now comes the important point for this categorization. So we are discussing about amortized cost. The contractual cash flows which the company will get or which the company will collect should be limited to SPPI. What is SPPI? Solely payment of principal and or interest. Now, in case when the company will collect rupees 100, what is it that they will collect? They will collect rupees 100. Is there any interest in this case? No, there is no interest in this case. So that means, what do we say? It meets the criteria of SPPI. Means the collection is limited to principal and or interest. There is no other component other than principal and interest or interest which the company is collecting in this rupees 100. Yeah. And now when we talk about the principal is very easy for us to understand. Principal is something which is contractual. So you have given 100 and you are receiving back 100 in terms of a loan. In terms of debtors, you have sold the goods worth rupees 100 and that's why you are collecting 100. So that's why we are calling rupees 100 as the principal. Let me take another example. let's say a loan is given. Company has given a loan. Again, the loan amount is rupees 100. Now, what's the business model of the company? To hold this financial asset, means to hold the loan till the maturity date, till the contract period, till the loan repayment period. So the company will hold this. Secondly, company will collect 100 rupees, and this 100 which the company will collect will only include principal and or interest. Now you may be thinking, but there is no interest in this. Let's suppose if this is interest free, so that is fine. See, this contractual cash flow should not have any component which goes beyond interest. It should be up to interest. If that is up to the element of interest, up to the interest component, it's fine. It will fall within this criteria of SPPI. But the moment it will include something else, means if there is any other return in this loan which will not be limited to principal and or interest, then it will fail SPPI test, and that's why it will not fall into this bucket. Clear on this? Yeah, all of you clear on this? So let me just give you some more examples for this bucketing. Lease deposit. Say a company has given lease deposit of 1,000 rupees. Yeah, and the lease deposit carries interest at the rate 7% per annum, and the period of the lease is what? 5 years. Okay. Now, if you look at the contractual cash flow in this arrangement, there are two contractual cash flows, or you can say there are two forms in which cash will be received. One is the principal, which will be equivalent to rupees 1,000, and that will be received at the end of 5th year. Second is interest. Which is, let's suppose, at market rate. Now this interest will be received every year. This interest will not wait till 5th year. This interest will be received every year. Correct? Now in this case, again, what do we need to check? If we have to classify this lease deposit as at amortized cost, then first of all, company should hold this financial asset up to end of 5th year, means up to the end of this contractual period. Number one. So its business model should be held to collect. Number two, the contractual cash flows which will arise from this financial asset should be limited to SPPI, which is happening in this case or not? Are those limited to SPPI or not? Tell me, yes or no? Yes or no? Are those limited to SPPI? The moment we say yes, then we'll say that this will meet the criteria. This will meet the criteria of financial asset to be subsequently measured at amortized cost. Clear? All of you? Then what we can now do is we can just look at some examples, very small examples around this. So let us now go to illustration number 1. Let us now go to illustration number 1 on page number 12.9. Page 12.9 of the study material. It's a very small illustration, simple one. So let's get on to this illustration now. Yeah, all of you are there on this illustration. A Limited makes sale of goods to customers on credit of 45 days. The customers are entitled to earn cash discount at the rate 2% per annum if the payment is made before 45 days, and an interest at the rate 10% per annum is charged for any payments which are made after 45 days. So now in this case, we need to check, we need to evaluate the financial instrument. We need to check what is this financial instrument. Yes, quickly, over to you. What do you think? Whether this instrument will be a financial instrument or not? And if yes, what type of financial instrument it will become, including its classification? Yes, quickly, over to you. Including its classification. So what do you think? Will this be a financial instrument? Will this be a financial asset? Yes or no? And in case it's a financial asset, under which bucket you will take it? Yes, I'm waiting for a response. Yes, quickly. Quickly, and just tell me the answer. Where do we take it? Easy one, huh? Yes. So if you look at this, what are we generating in this case? In this case, we are generating trade receivables. Correct? So will that be a financial asset? Yes. Now comes the next point. Will this financial asset be measured at amortized cost or not? That's the question. Will this financial asset be measured at amortized cost or not? Yes, quickly. Can you tell me whether this financial asset, in this case, will be measured at amortized cost or not? You can check it out. And the conditions are also there. On the basis of those two conditions, you can check whether this will be measured at amortized cost or not. Vaibhavi is saying yes, sir. This will be measured at amortized cost. Can you tell me why? Can you tell me why this will be measured at amortized cost? Reason, please. Huh? So first of all, if you look at the business model of this entity, what do we say? Entity will collect cash. That's the business model. Yeah, clearly they are collecting contractual cash flows. So their model is to hold the financial asset, hold the trade receivable to collect this. So this is covered. Secondly, when they are collecting the contractual cash flows, what are those contractual cash flows? They are limited to principal and interest. Principal and interest. Do we have any return in this contractual cash flow which goes over and above interest? No. That's why, what do we call this type of financial asset as? What do we call this type of financial asset as? This will be classified as at amortized cost. So I can see now many responses from your side. Pujita is saying yes, sir. It's measured at amortized cost because the only obligation is to receive cash. So it's not about obligation. There's right to receive cash. Okay. Yeah. And Rohita is saying it's about holding to collect and cash flows will be limited to SPPI. Very good. Coastal is saying yes because it will fall under amortized cost considering the fact that contractual cash flows will be limited to SPPI and the model is all about holding to collect these contractual cash flows. Okay. Now we can move on to another example. So another illustration. On the same page, let's move on to illustration number 2. On the same page, let's move on to illustration number 2. Yeah. Yes, you can just start reading this quickly. Z Limited makes sale of goods to the customers on credit. Goods are carried in large containers for delivery to the dealers' destinations. All dealers are required to deposit a fixed amount of rupees 10,000 as security for the containers, which is returned only when the contract with the company terminates. The deposits means the fixed deposit which the dealers will give to the company, that means Z Limited, will carry 8% per annum interest, which is payable only when the contract terminates. So interest will be carried but paid at the time of termination of the contract. If the containers are returned by the dealers in broken condition or any damage is caused, then appropriate adjustments shall be made from the deposits at the time of settlement. So they are saying there will be a settlement in relation to the deposit amount in case the containers which have been given to the brokers, they get broken. So now in this case, you need to check about the deposits, whether these deposits will be financial instrument or not. And in case those are financial instruments, what do you call that as, including their classification? Quickly, I think this is again very, very easy for you to answer. Yes, quickly. It's very, very easy for you to answer quickly. Huh? Tell me. What do you think? Will this be a financial instrument? Yes or no? Where do you classify this in case it's a financial instrument? And what's the reason for you to conclude that? Yes, quickly, I'm waiting for response. Yeah, what's your response? So if you look at the deposit, do we have a contract in case of deposit? Yes. And through the contract, do we receive cash? Yes. So what will it become? It will therefore become financial asset for Z Limited. Because Z Limited will receive cash at the end of the term. Now, moving on to its categorization. We need to check whether it will be measured at amortized cost or not, because other terms, other classifications we have not yet discussed. So you can only check whether it will fall under amortized cost or not. Yes or no? Yeah. So can you just quickly tell me now whether it will fall under amortized cost or not? Yes. Over to you quickly. What do you think? It will fall under amortized cost or not? The criteria is very simple. So let's see. In this case, the company does not intend to do away with this deposit. Z Limited will keep the deposit with itself till the time the contract is terminated or till the time contract will come to an end. So that means what's their business model in relation to that deposit? Hold to collect. And when they will collect contractual cash flows, what will those cash flows be? SPPI only. As we can see, they will receive the principal, and on the principal they will receive interest. Are they going to receive anything over and above interest? No, they will not receive anything over and above interest. So that's why, what will this instrument become? This instrument will also become amortized cost financial asset. Okay, and let me just see the response from Webby. Webby is saying yes, sir, because it meets the SPPI condition. That's why it needs to be taken to amortized cost. Pujita is saying, so security deposit will be a funds instrument as they are only there to receive cash at the end. These deposits are not meant for sale, very good, but only to collect the interest and principal. It will therefore be categorized at amortized cost. Great. Yeah. So I'm hoping that you are now clear around this concept of financial asset and the financial asset which will be measured at amortized cost. Okay, clear on this? And what you should do now is you should mark illustration number 3, 4, so mark illustration number 3 and 4 as your homework, please. And you can also note down the page number. $12.10. Small illustrations, but good for your practice. Okay, so now we have discussed about amortized cost. Let us now move further. Say, for example, in this model or with this overall modeling, okay, I'm not limited to this business model. Let's suppose with these two, I add one more aspect, that a company, along with holding to collect, sells financial assets. So what's the business model of the company? The business model of the company includes two things. First, they are holding the financial asset to collect. Secondly, they also sell the financial assets. And you will be thinking, sir, how can the financial assets be sold? Yes, they can be sold. Let's take one example again. Yeah, because all of these things can be best understood by taking an example. Yeah, all of these things require an example for more clarity. Let's suppose company has got many debtors. And generally, debtors have a credit period of 60 days. And I'm sure you will be knowing about it, that debtors can be sold in the market, which is called as discounting of debtors. Yeah, it's nothing but a sale of a debtor. So what we have observed in relation to this company is that this company holds some debtors till maturity, means hold some debtors to collect, and this company also sells some of its debtors as and when required. So in case the company will need money, let's suppose before 60 days. Now the debtor will make the payment in 60 days, but let's suppose the company needs money in 15 days. So what will the company do? Company will reach out to a banker. Company will ask the banker to discount those debtors. Or in other words, we can say company will sell its debtors. So that means company is also selling some of its debtors. Okay, yeah. And the third criteria, or you can say the second condition, is about contractual cash flow. Now, will this contractual cash flow be relevant for sale of financial assets? No, because when the debtors will be sold, so whatever banker will give, that will become the cash flow. But for some of these financial assets which are held to be collected, their cash flows are still continuing to be limited to SPPI. Means for them, company is not going beyond SPPI. Company is limited to SPPI. In such a case, such financial assets, in such a case, categorization will now change from amortized cost to fair value through OCI. Fair value through OCI. So now only a single change has been made by us. If you look at it, what's the single change? We have included in the business model sale of financial assets. And all other things still remain same. This is also included there. This is also included in the business model. With the inclusion of sale of financial assets along with business model to hold to collect. So that means now the business model includes both the things. Some are held to collect and some are sold as and when required. The moment the business model changes like this, then the categorization will not be amortized cost for the financial assets. Then the categorization will be then the categorization will be to measure the financial assets at fair value through OCI. How the measurement will happen, how the accounting will happen is yet to be discussed. So far, I'm just limited to this categorization or this modeling for the time being. Okay, yeah. Now, this third category, fair value through P&L, on which I'll need your help. And I'm sure that if you would have heard both these categorizations carefully, you will be very easily able to answer these questions. Yeah, okay. So let's understand that. Fair value through P&L. What's the third category? Fair value through P&L. That's the third category. That is also the residual category. Means any financial asset which will not fall under amortized cost or fair value through OCI will go to this bucket automatically. Okay, you can say residual category. Can you tell me? So this is one way to categorize any financial asset into this bucket. I'm just repeating my point. I'm saying if any financial asset will not fall under amortized cost or fair value through OCI, where will it go? Fair value through P&L. But other than this residual approach, wherein we check whether a financial asset will go here, then it, or if not here, whether it will go here, if not here, then it will go here. Can you just think of some criteria on the basis of which we can directly check, or you can say under what conditions a financial asset should go to fair value through P&L? So you can say, sir, it's very simple, huh? It's very simple. That first of all, let's check whether it's amortized cost or not, then check whether it's fair value through OCI or not, and accordingly you can answer this. No, I'm saying even if we don't check it, what will be those conditions on the basis of which we can just immediately make out, immediately say that the financial asset will go to fair value through P&L, or you can, or in that words, I can say that what will be the criteria for any financial asset to be taken to fair value through P&L? Yes, quickly. Can you think about those situations? Can you think about those conditions quickly? And the answer is there on the board. I can just tell you, answer is there on the board. So you can just think about all of these things carefully. You will easily be able to make out the conditions in which financial asset will fall under fair value through P&L. Yes, I'm waiting for a response. Huh? Conditions under which financial asset will go to fair value through P&L. Yes, I'm waiting for a response. Under which conditions financial asset will go to fair value through P&L? Let me just see who can answer this. Okay, great. Rohita has given one answer. Rohita is saying that it's so simple, and it's true that when there is only sale of financial assets, means the business model is not about holding to collect. Business model includes only sale of financial assets. Very good. Only sale of financial assets. Is there anything else that comes to your mind? Yes, quickly. Okay, Kaustav is saying, sir, business model is not to hold for collection or payment of additional element other than principal or interest. Pujita is saying, those assets which are held only for the purpose of sale and not held to get cash flows, be it interest or principal. Yes, again, great thing. In case there is any financial asset for which SPPI criteria will fail, then where do we take it? Fair value through P&L. So wherever SPPI fails, what do we call it as? We will call it as fair value through P&L bucket. It no doubt remains to be a residual bucket. But even if we have to just think about it, that in terms of residual bucket, which all items should get covered? So these are the items which should get covered in the residual bucket. Okay, clear on this? Yeah. So let's take some examples of this third bucket, fair value through P&L. Yeah. let's take some examples for this third bucket. Investment in convertible debentures. Yeah. Let's suppose A Limited invested in convertible debentures. Now, please understand that we are now looking at holder's side. You remember at the beginning of the session, I told you that which standard will be relevant for the holder? 109. So we are now in the context of 109 and we are now looking at the perspective of the holder. So who is the holder? A Limited. A Limited holds the investments. We are checking for holder because only holder will have an asset. Issuer cannot have an asset. Issuer can only have liability or equity. Correct? Yeah. Now, for this holder, we need to check, first of all, whether this investment is a financial asset or not. Yes, quickly. In the meantime, I also received this response from Bharat. He has also tried to respond to this. Very good. Okay, so tell me whether this investment in convertible debentures will be considered as a financial asset or not. Because what's the first thing that we need to check? Whether it's a financial asset or not. Because once that is checked, whether it's a financial asset or not, then we'll have to check under which bucket we will go. Okay. Now for a financial asset, what do we need? Contract. So it's there. And through a contract, what should we receive? Cash. Yes. Or financial asset of another entity. Or it may be equity instrument of another entity. Now, when it is convertible debenture, what does it mean? That principal will get converted into equity. That means the principal component is what? Principal component is equity of another entity. And the interest component on debentures, interest will be mandatory. Interest component will be received in cash. Yeah. So it meets the criteria of financial asset. So we receive cash. Yes. Or we can say there is another component of equity instrument, on the basis of which we will say it's a financial asset. Now, once we can see a financial asset so once we can say the criteria of financial asset is ensured, what do we now need to check? Whether it's amortized cost, fair value through OCI or fair value through P&L. Now for this to be called as amortized cost, what do we need to check? First, are we holding this to collect? Yes, we are holding this to collect. So there is no model of the entity to sell this investment. Okay, so this condition is fulfilled. Second, FVPL. In this case, let's think about it. What will the entity receive? What will the entity receive? Anjali is saying, sir, it will be equity. Okay, sure. Now in this case, what will the entity receive? In this case, entity will receive interest year on year, but will the entity receive principal? No. And when the entity will receive principal later on, what is it linked to? Equity shares. Principal is nothing but the equity. So the moment we bring in equity, can we say that the return on the equity is limited to interest portion on it or the principal portion on it? Because equity may go down or it may increase significantly in terms of the returns which will be attached on that part. Yes or no? Yeah. Therefore, what will happen? It will fail SPPA. It will fail SPPA. The moment we say it will fail SPPA, can it go under fair value through OCI? No. Because for fair value through OCI, this condition is required. So that means this will also not go to fair value through OCI. So what is the residual category? Fair value through P&L. So wherein the SPPI fails, So where will this instrument go? This instrument will go to fair value through P&L. Now, one very, very interesting point I'll discuss with you and very crucial, and which has, sort of raised by Anjali also. Anjali mentioned that, sir, this instrument is equity instrument. And there's no doubt that this instrument has some component of equity. There's no doubt this instrument has some component of equity. But you always need to remember that whatever is equity for one will not be equity for another entity. So the context in which we are discussing, you always need to remember. In the exam also same problem may happen. For example, what was our question? In this case, our question was whether it will be financial asset or not. Yeah. And why we are checking it will be financial asset or not? Because we are looking at the holder's perspective. We are looking at it from the holder's side. If you look at it from the issuer's perspective, then it will not be considered to be a financial asset. It will either be a financial liability or equity, or it can be a mix of those two, which we'll discuss later on. And which is, I think, to some extent, I am not sure, Anjali, whether you wanted to answer this way or only, or maybe this could also be a confusion to your mind. So that's why it's very, very important for you to clarify that to some extent, you may get confused in the exam and you may answer this instrument as equity or maybe compound instrument or anything. Yeah. The moment you do that, though you will be answering right from the issuer's perspective, but that is not required in the question right now. The question is asking you to check from the holder's perspective whether it will be financial asset or not. Clear? Yeah. So in the exam, you always need to be very, very clear that are we required to comment on a particular instrument from the holder's perspective or the issuer's perspective? Because accordingly, you will look at the classification. Accordingly, the measurement may also change, and I'll tell you how the measurement may also change. All of you clear on this? And I'm hoping, Anjali, you are also clear on this. And I'm sure this could be a confusion to many of you, but you might have not raised your query around it. Yeah? Clear? Clear on this aspect? Yeah? Okay, so now we can move further and we can get into some finer details of SPPI and the business model. So we have so far broadly understood. The classification requirements. Yeah. Now we need to get into the details of all those classification requirements. For example, if you look at amortized cost, we discussed that the business model should be hold to collect. We'll now get into more details of that business model. We'll get into more details of SPPI. There's so many things around these conditions which we need to study in more detail. But before that, Before that, one another point which you need to understand, that is about accounting requirement, because that is why we are doing all of these things. Amortized cost, fair value. So largely these two are the buckets. When an instrument will be bucketed under amortized cost, its measurement will happen at amortized cost. It will be measured at amortized cost. How it will be measured at amortized cost is yet to be discussed. So we'll come to it later on. How it will be measured at amortized cost, because it's a new concept. For many of you who might have not done this earlier, it may be a completely new concept. So I'll come to it, how the measurement will happen at amortized cost. Second is fair value. So in case an instrument is not measured at amortized cost, or it's not bucketed over here, let's suppose it's bucketed over here, how do we measure it subsequently? Again, we'll have to fair value that instrument. And why I'm saying again, because at the time of initial recognition, every instrument, every financial asset is getting fair valued, and subsequently also in this bucket, this is getting fair value. Now, what's the difference between fair value through OCI and fair value through P&L? The only difference being that in case it's bucketed under fair value through OCI, then the changes in fair value, please remember, changes in fair value of the instrument will go to OCI. And in case the instrument is bucketed at fair value through P&L, then the changes in fair value will go to P&L. Then the changes in fair value will go to P&L. Okay, all of you clear on this? Clear on this point as to how the measurement will happen? Yeah? Okay, so before I move further on to this, let's quickly discuss any of your queries around it. So before I get into more details, because that will be a sort of new discussion that we'll have to start, it will be good to understand your queries, any doubts in case you have. Yes. Yes, quickly. Any questions, any doubts in case you have, please let me know. Any doubts, any questions in case you have? Any questions, any doubts from your side, please let me know. I'm waiting for the questions. So I'm not planning to start with a new thing now. I think it's better that we can just discuss around whatever we have covered so far. Yes, quickly. Yes, any questions, any doubts? Yeah. Okay, so what we can do is, if you don't have any question, then we can move on to one illustration. Yeah, so you can just move on to illustration number 8. This is page number 12.19. Page number 12.19. Illustration number 8. Silver Limited issued irredeemable preference shares with face value of rupees 10 each and premium of rupees 90. So they have issued irredeemable preference shares. Irredeemable means which will not be redeemed. These shares carry dividend at the rate 8% per annum. However, dividend is paid only when Silver Limited declares dividend on equity shares. Now, in this case, you need to analyze the nature of this instrument. Now, because these are preference shares, that's why you need to comment on this from the issuer's perspective. And you will also have to understand that in the exam, how will you get to know whether you need to comment on this from the issuer's perspective or the holder's perspective? Because all information which is available in the question is from the issuer's perspective. It's all from the issuer's perspective. Yeah. So let's understand this quickly. So if you look at the preference shares, it has got two components. If you look at the preference shares, it has got two components. First is the principal and second is interest. Now, because the preference shares are irredeemable, so will there be an obligation on the part of Silver Limited to pay cash? The answer is no. So will this become a financial liability on account of principal repayment? No. If you look at interest, will there be an obligation on the part of Silver Limited to pay cash towards this interest? This interest is nothing but dividend. So you may be thinking, sir, why you are calling this as dividend or interest? Because interchangeably these terms may be used under financial instruments. So we can say yes, there is an obligation on the part of Silver Limited to pay this dividend, but there is an obligation on the part of Silver Limited to pay this dividend, but this is something which Silver Limited can avoid. How? So if Silver Limited does not pay dividend on equity shares, it will not be required to pay dividend on preference shares. So that means its payment is again within the control of Silver Limited. It's not something which is mandatory. It's not something which is unavoidable. So that's why this will also not become a financial liability. Correct? So that's why, what do we say? There's no obligation on the part of Silver Limited to pay cash or to give another financial asset. So therefore, what will this instrument become? Therefore, this instrument will become equity from the perspective of Silver Limited. So Silver Limited will therefore call it as equity. For Silver Limited, this will become equity. Clear? All of you? Yeah? Okay, so I have some queries in between. I'll just quickly get on to those queries. Preeti is asking, sir, in SPPI, both the conditions need to be met in terms of principal and or interest? Yes. And you should call it as and or interest. So it may not be interest. So at times interest, it may be interest free. So still it will meet SPPI. So it's not necessary that interest has to be there. Even if it's interest free, that can still be called as meeting the SPPI criteria. Vaishnavi is asking, sir, in case of fair value through OCI, holding till maturity is a must? Yes, because this should include both the models, hold to collect as well as sale. Because if it's only sale, then it will not be fair value through OCI, it will go to fair value through P&L. Then Mridula is asking, sir, in illustration number 1, for the cash discounts, that is 2%, are there any adjustments required? Yes. When you do the accounting, adjustment will be made for this cash discount. But for the purposes of our assessment, this will not impact our assessment. Yeah, because for the purposes of our assessment, what do we look at as? This is a normal transaction which is meeting the criteria of SPPI. And for this criteria of SPPI, we'll get into greater detail. Okay, we'll get into more detail. And for this business model also, we'll get into more detail in our next session. So next session, we are going to get into more detail around both of these things, as well as some of the aspects related to fair value through OCI and fair value through P&L. Once we are done with that detailed discussion, then we'll get on to these accounting requirements. Then we'll start doing the accounting for financial assets at amortized cost, because fair valuation is something which is very simple. So you can get the fair valuation done, and the changes in fair valuation will go to OCI or P&L, whichever be the case. All right. Yeah. Any more questions from your side? No. All right. So with this, we can just conclude our discussion for today. And I would just request all of you to please revise all of these things which we have studied throughout the sessions of financial instruments. You will have to just ensure that each and everything that we have been discussing in the session, you are revising before the next session. Because in case you lose out on any of these things in the next session, you will find that next topic difficult to understand. This session is, this topic is very significantly interrelated to various subtopics that we have been discussing. So that's why your revision will be extremely important for your thorough understanding of financial instruments. Yeah. So that's another homework from you, for you, other than a couple of those illustrations which I have given. All right. Yeah. So with this, I would just like to thank all of you for your time and for your wonderful participation.